Welcome back. Today we're doing a deep dive into Tesla's 2024 annual report. We've got the Form 10K right here, and our goal is really to pull out the key insights, what's happening with their different business areas, the financials from last year, and what they're planning next.
Yeah, it's always interesting with Tesla. They're much more than just cars now, aren't they? The report really lays out these distinct segments, each with its own logic, its own challenges.
Okay, let's kick off with automotive then.
Yeah.
Still the biggest piece, right? Their direct sales model online, their own stores, that's a core strategy.
It is. And they say it helps control costs, build the brand, and get that customer feedback loop going fast.
Which is definitely different from the old dealership way.
Totally.
Yeah.
And the report mentions they're always kind of tweaking that model, globally and locally. Plus, they're folding the used car business right in. Trade-ins, lease returns. It feeds back into the new car side.
Right, like a whole ecosystem. And it seems the focus isn't just raw volume anymore. They talk about profitable growth, using the factories they already have to make newer, more affordable cars. That feels important.
Absolutely. Using existing infrastructure, that's smart. Saves capital. And then, of course, there's the whole FSD thing, full self-driving.
Supervised
Yeah.
FSD, yeah,
Yeah.
where you still have to watch it.
Right, supervised for now. But the big picture, the roto-taxi or cybercab, as they're calling it, that's the long game they're playing.
Yeah, and the scale is just immense when you look at it. They're pushing to ramp up production everywhere, use more of their factory capacity, get better at delivering the cars.
Uh-huh. And constantly improving the tech, the vehicles, the batteries, plus that push for vertical integration, localizing supply chains. It's a huge, complex operation.
It really is. And they're pretty open about the headwinds, too.
Yeah, the report mentions the usual auto industry cycles, the macro stuff like inflation, interest rates.
And rising competition, obviously. That's a big one now.
Definitely. Plus, supplier risks, component allocations. It's a lot to juggle.
So the actual numbers for 2024, about 1.77 million cars produced.
And nearly 1.79 million delivered. Pretty massive numbers.
And they had the updated Model 3 last year, with the new Model Y supposedly coming in Q1 2025.
That's the plan. Though, as you know, those new model ramps can sometimes cause short-term production hiccups while they retool.
Always something.
Oh,
Okay, let's switch gears. Energy generation and storage. That part seems to be really picking up steam.
it really is. Big growth there last year. Their strategy seems to be about simplicity, standardization, making it easy for everyone from homeowners to utilities.
Right. Selling through the website, stores, partners, and those big power purchase agreements, the PPAs. Trying to keep customer acquisition costs down by making it simple.
And they offer financing for homeowners too, which helps adoption. The big push is just scaling up, getting more energy storage deployed. What was it? 31.4 gigawatt hours in 2024.
Yeah, that's a huge number. That's a lot of energy.
It is. And those mega factories ramping up in Shanghai and Lathrop, California are key to hitting those numbers.
But similar challenges to the car side, I guess.
Yep. The report flags dependence on volume growth, needing that steady supply of battery cells.
And the whole policy landscape, right?
Yeah.
Incentives, tariffs that can change things quickly for renewables.
Exactly. Okay, so manufacturing. This kind of underpins everything else.
But yeah, the foundation, big facilities now, California, Texas, Nevada, New York.
Plus Shanghai and Germany. And they're not just assembling cars, they're making battery packs, cells, solar components, the whole 9 yards.
And the plan is just more
Yeah.
capacity, right? For Cybertruck, the Semi, whatever comes next on that new platform.
Ramp up the gigafactories, make the existing ones more efficient. That's the goal.
It's interesting how interconnected it all is.
Yeah.
The next growth phase isn't just building factories.
No, it's tied directly to autonomy getting better, those new vehicle platforms actually launching, and their huge bet on making their own battery cells. High volume, lower cost, more range. That's the dream.
But they're realistic about the difficulties, too.
Oh, yeah. Ramping up new manufacturing is tough, especially with new tech, projects all over the world, component shortages.
And those external things they mentioned, like the Red Sea issues, that arson attack stuff happens.
And hitting those battery cell targets,
Yeah.
that's ambitious, a big challenge.
Okay, one last segment note. Sales and marketing. Historically quite different for Tesla.
Yeah, very low traditional ad spend, mostly relied on, well, buzz and the brand itself.
They mentioned monitoring the narrative, doing customer education, targeted ads when needed, but it's not like legacy auto.
Speaks to the brand power, I suppose.
Okay, let's shift to the financials. 2024 versus 2023. What are the big
Well,
headlines?
total revenues were up slightly, $97.69 billion compared to about $96.8 billion compared to about $96.8 billion. So a small increase.
Okay, top line grew a bit, but net income, that took a big hit.
It did, down to $7.09 billion from $15 billion. But there's a huge asterisk there. The report makes it clear that drop is mostly because they released a massive $6.54 billion valuation allowance in Q4 of 2023.
Ah, okay, a valuation allowance.
Yeah.
It's like a reduction against deferred tax assets.
Exactly. And when they decided they didn't need it anymore, releasing it gave a one-time massive boost to 2023's net income.
Gotcha. So 2023 was artificially high because of that accounting move. That context is key.
Absolutely crucial. It makes the year-over-year comparison look much more dramatic than the underlying operational change.
Okay, what about cash? Their position looks pretty strong.
Very strong. Cash, equivalents, and investments jumped from around $29 billion to over $36.5 billion. That's a healthy increase.
And operating cash flow.
Also up $14.92 billion from $13.26 billion. So the core business is generating more cash, which is good.
But they're spending more too. Capital expenditures went up.
Yeah, up to $11.34 billion from $8.9 billion. The report says that's mainly AI investments in building out factories globally. Makes sense with their plans.
Okay, let's look inside the automotive revenue number. It was down overall.
Right, down to $77 billion. But interestingly, regulatory credits were up quite a bit, $2.76 billion.
So those credits are still a significant chunk of change for them.
They really are. Meanwhile, actual car sales revenue and leasing revenue both dipped.
Could be pricing, mix, the economy. Lots of potential reasons there.
Could be. But the flip side is the energy segment revenue. That jumped significantly.
Yeah, $10 billion, up from $6 billion. That's impressive growth.
Definitely showing strength there. Now, looking at costs, total cost of revenues crept up a bit.
Which meant gross profit was down slightly.
Just slightly, yeah. And the overall gross margin dipped a tiny bit from 18.2% to 17.9%.
But the energy margin improved.
It did, up to 26.2% from 18.9%. That's a really positive sign for the profitability of that growing segment.
Okay, what else? Income taxes, that swung wildly.
Yeah, from a huge benefit in 2023 to a $1.8 billion expense in 2024. But again,
The valuation allowance effect from 2023.
exactly. That skewed the effective tax rate massively last year. This year's 20% rate is more, let's say, normal looking.
Right, and R&D and SG&A expenses both went up.
Yep. More spending on research and development and the general costs of running a bigger global company reflects the growth and investment.
Okay, so summing up the financials. Modest revenue growth, net income heavily impacted by that prior year accounting item, strong cash growth, more investment, and improving margins in energy.
That's a pretty good snapshot.
So given all that, what are their plans for shareholder value? Direct returns, dividends, buybacks.
Well, the report's pretty blunt about dividends. They've never paid them, and they say they don't expect to anytime soon.
No surprises there, really.
Nope. Any future decision depends on, financials, capital needs, the usual caveats.
And share buybacks. Anything mentioned?
Not explicitly in the sections we're looking at here. Their focus seems squarely on reinvesting for growth. Profitable growth, cost-cutting, operational efficiency, leading to more deliveries, more deployments.
Plus pouring money into R&D, especially AI and software, hoping for future revenue streams, like from the fleet.
Exactly. The idea is that the growth itself is largely self-funding these big capital projects, and they expect to keep generating positive operating cash.
So the strategy is grow the pie, make the company intrinsically more valuable over time rather than handing out slices right now.
That seems to be the core philosophy, yes. Long-term value creation through innovation and scaling.
Okay, let's pull it all together then. Assessing the business moving forward based on this report. What's the outlook?
Well, clearly, future growth rides heavily on manufacturing execution. Can they scale up capacity? Can they ramp up these new models and factories efficiently? That's huge.
And the tech side too, right? Autonomy actually progressing, new products on that next-gen platform hitting the market.
Absolutely essential. And underpinning all of that is the battery situation. Securing enough cells, potentially making more themselves cost-effectively. That's fundamental to hitting production and cost targets.
And then there's the market itself. People need to keep wanting EVs, and specifically Tesla EVs, even with all the competition.
Right. Consumer demand is key. And maintaining public trust and confidence, that's always vital for Tesla, given how much attention they get.
Plus navigating all the regulations globally. Safety, self-driving rules, direct sale bans, energy policies. It's a minefield.
It's complex. And managing the supply chain, avoiding shortages, dealing with material price swings that remains critical day to day.
But on the plus side, their focus on cost reduction, innovation, trying to get more operating leverage as they scale, those are potential strengths.
For sure. And that big cash cushion gives them a lot of flexibility to invest and weather any storms.
So it really paints a picture of a company still in aggressive growth mode,
Yeah.
juggling huge opportunities with significant challenges.
I think that's fair. A major phase of expansion and investment, trying to solidify their position in automotive and really ramp up the energy side.
Okay, so let's wrap up this deep dive. Key takeaways from the 2024 report. Tesla's pushing hard on multiple fronts, automotive and energy. The financials showed modest top-line growth, but that big net income drop was mostly due to a 2023 accounting item.
Right. And direct shareholder returns like dividends, not on the immediate agenda. The focus is reinvestment.
And the future really depends on nailing manufacturing scale-up and continuing to innovate, especially in autonomy and batteries, all while navigating a tougher competitive landscape.
That covers the main points, I think.
Which brings us to a final thought for you, the listener. Tesla's stated mission is accelerating the switch to sustainable energy. Thinking about all these operational details, the financial results, the challenges, how much progress are they actually making towards that huge goal? And what hurdles seem biggest? And maybe more broadly, what role do you see individual choices and the bigger market forces playing in whether that sustainable energy transition actually happens at the speed Tesla envisions? Something to ponder.